Hello everyone, my name is Elliot Gu. I'm co-founder of Energy and Income Advisor, as well as the Free Market Speculator publication right here on Substack. And today I want to talk a little bit about specifically oil, crude oil, and which has been a wild ride recently if you haven't noticed, as well as sort of energy more broadly, some of the risks and opportunities I see in these groups going forward, and one of the reasons why I'm actually interested in energy at all as an investment opportunity right now. So first up, let's start with what I think is probably the most frustrating thing I see as an energy analyst. One of the most frustrating things I think there is about energy and oil specifically in the mainstream media, and that is the geopolitical risk premium, the idea of a geopolitical risk premium in oil. And the idea that seems pervasive out there that in the mainstream media and also among a lot of individual investors I talk to, a lot of times I get asked about this, is the idea that oil trades solely off geopolitical events and geopolitical news, and that geopolitics or military action in the Middle East is absolutely crucial to analyzing energy commodities, oil specifically, natural gas as well as energy companies. Now I'm here to tell you, and I've said this many times here, as well as across all the publications I've managed for the last 25 years related to energy markets, and that is geopolitics does not drive sustainable moves in oil prices. Now, I know that you're going to hear exactly the opposite from a lot of mainstream media outlets out there. You're going to hear people on places like X, Twitter, social media talking about, oh, well, what if Iran closes the Straits of Hormuz? What if they bomb Saudi Arabian oil production facilities, or a drone attack on Saudi Arabian oil production facilities, and this blows up into a wider geopolitical conflict? And you'll see oil react on that in a short-term basis for sure. But it's not, these moves are never sustainable. And that usually geopolitical headlines almost always are an opportunity to fade oil. In other words, short oil or sell out of oil if you own it, at least on a short-term basis, when you see these geopolitical headlines. And this is nothing new. I saw a headline out this morning. Today is the 25th of June that I'm recording this. I saw a headline out this morning from a major media outlet, and I'm not going to mention who it was, but they said, why, and the headline was something along the lines of, why the oil markets changed such that geopolitics no longer matters as much as it once did. And I'm here to tell you that this is absolutely nothing new. As you probably hear, I'm a little frustrated today with this. This is absolutely nothing new. Geopolitics has never had a sustainable impact on oil prices. It's not something that's happened in the last year, the last 5 years, even the last 20 years, right, where U.S. shale production has become more important, and therefore we're less reliant on imports of oil from the Middle East than we once were. The reality is that this has been a situation for far longer than that, and let me start out by just showing you an example of what I mean from 35 years ago, okay? This is the 1990-1991 Gulf War, the first Gulf War under President George H.W. Bush. And I'm going to talk about oil, what happened to oil over this time period, and also some of the main events over this time period and how oil reacted to those events over time. And the reason I'm picking this one in particular from 35 years ago is, first of all, to show you how long this geopolitical idea about trading oil based on geopolitics has been totally wrong, but also because this is an example of any event in the last 40 plus years, right, where you actually did have serious risk to oil facilities and major oil producers. You had Iraq, of course, Kuwait, and Saudi Arabia, the United Arab Emirates. All these countries were right in the theater, a military theater, a major ground and aerial bombardment across the region. You had Iraq launching Scud missiles at Saudi Arabia, the world's most important, largest oil exporter then and now. And so there was real risk in the region, yet it didn't have a sustained impact on oil prices. So let's jump right into the chart. This is actually a chart of WTI, West Texas Intermediate oil prices from January 1989 through the summer of 1991. And I've labeled some of the key events over this time period. So you can see leading up to the summer of 1990, oil prices were basically trading in a range between roughly $17.50 all the way up to about $25 a barrel. So they were trading in that range. Now, on July 17th of 1990, the then president of Iraq, Saddam Hussein, accused Kuwait of stealing oil from the Rumaila oil field, which is a very important oil field. And what they basically accused him of doing, of the Kuwaitis of doing, was horizontal drilling or slant drilling into the Rumaila oil field, which is in Iraq, and stealing oil from the field, literally stealing oil from the field. It's actually Iraqi oil. And they also accused the United Arab Emirates, the UAE, of overproducing on their OPEC quota. So this was July 17th of 1990. And you can see that oil started to make its way up to around the middle of that $17.50 to $25 trading range that had prevailed up to that time. Now, on August 2nd of 1990, Iraq invaded Kuwait. Okay, so again, two of the largest most important oil producers in OPEC and the world actually militarily invaded Kuwait. August 2nd, 1990. This action was almost immediately condemned by the United Nations. However, U.S. President George H.W. Bush actually ordered the deployment of U.S. troops and significant equipment to Saudi Arabia at the request of then King of Saudi Arabia, King Fahd. Okay, so you can see that happened later on in August, in about mid-August of 1990. And oil prices at that time were trading up around the high 20s per barrel, so above that range. So we are seeing some movement in oil around the actual invasion. Now fast forward to October of 1990. Through the month of October 1990, there was a major intensification of the troop deployment to the region. And in particular, this was a time when the focus of U.S. and coalition troop deployment to Saudi Arabia kind of moved from a purely defensive play, so Desert Shield, to potentially being more of an offensive play. In other words, the need to actually take military action, not just to protect Saudi Arabia and Saudi Arabia's oil fields, but also potentially to push the Iraqis out of Kuwait, so to reverse the invasion. So we saw a major buildup of U.S. and coalition troops in Saudi Arabia and equipment in October 1990. Now, November 29th, 1990, very important date. Okay, now at that time, as I should have said, oil prices were up around $40 a barrel. So big move off those lows, no doubt. Over about a 2-month period, that 2 to 3 month period was a major move in oil prices from under the low end of that, at the low end of that trading range, $17.50 a barrel, all the way up to $40 a barrel. So this, again, 2 to 3 month period roughly. Then, November 29th, 1990, very important date, the United Nations Security Council issued a resolution authorizing the use of all necessary means to force Iraq out of Kuwait. They also set a deadline of January 15th, 1991 for Iraq to exit Kuwait, to leave, or potentially they were going to take military action against them. So there was a deadline for the start. It was considered a deadline for the start of an actual war in the region. Now, here's what's interesting. By the time the UN released that resolution, oil prices were already well off their highs. They were back down to the low 30s from near $40, over $40 at one point in October of 1990, down to the low 30s. Okay. Now, let's fast forward to January 17th, 1991. This was the start of Operation Desert Storm. Now, Operation Desert Shield was the act of, which started in August of 1990, was the act of protecting Saudi Arabia, protecting the region, and repelling any potential attacks out of Kuwait into Saudi Arabia. And then the actual start of Operation Desert Storm was an aerial bombardment, airstrikes, launched out of Saudi Arabia, targeting Kuwait and Iraq. Now, this started, as I said, January 17th, 1991. There was a brief spike in oil up into the 30s around this time. However, oil prices were trading more like the mid-20s, so back kind of at the top end of that long-standing trading range at the time the U.S. actually launched Operation Desert Storm. Now, by the time the actual ground invasion started, okay, in late February of 1991, oil prices were already trading down to $20 a barrel, so already down more than 50% from that peak. Now, these are just, of course, some of the dates that were important in that Gulf War in 1990, 1991. And I'm going to throw up here a timeline I have with just a couple of, a number of other important dates from 1991, just to give you an idea of some of the headlines that were crossing the wires at that time. 18th January 1991, the Iraq launched its first wave of Scud missiles targeting both Israel and Saudi Arabia, and WTI closed around $20.05 a barrel. Now, those of you who were live at that time or might remember, these Scud missiles were these old Russian missiles that Iraq had that were not very accurate. Basically, they just fired them in the general direction of a country, and they were timed such that when they ran out of gas, they would actually fall into a city. So they were able to target sort of maybe a city or an area of a country, but these were not very accurate missiles. They certainly were nothing compared to the Tomahawk missiles the U.S. was using at that time, which were much more precise. On the 22nd of January 1991, Iraq began setting fire to hundreds of Kuwaiti oil wells, and WTI closed around $24.91 a barrel. On the 25th of January 1991, Iraq intentionally released millions of gallons of oil into the Persian Gulf, and WTI was trading around $24 a barrel. Right at the end of January 1991, Iraqi forces attack a Saudi Arabian border town and are successfully repelled by coalition forces. WTI was trading a little under $22 a barrel. And as I said, the ground war actually began with coalition forces advancing into Kuwait and Iraq on the 24th of February 1991. And at that point, oil was trading at $17.43 a barrel. So look at what happened here, right? We had an actual war, okay, in the most crucial region in the world for oil production and exports then and now, right? Yet we only saw a very short-lived jump in oil prices that lasted between 2 and 3 months, between the summer of 1990 and say October of 1990, when a date for a military, the start of military strikes and invasion of or repelling of Iraqi forces from Kuwait was set in November 1990. Oil was already well off those highs. By the time airstrikes began in January 1991, oil had fallen even further. And by the time coalition forces actually advanced into Kuwait and Iraq, oil prices were back below where they were trading when this all started in the summer of 1990. So even then, geopolitical headlines had only a very temporary impact on oil prices. And the reason is that leading up to 1990, the summer of 1990, oil prices, as I said, they'd been in a range, and the supply and demand outlook for oil was actually really weak. There was excess supply relative to demand growth. Demand growth was healthy, but there was just too much oil being produced around the world at that time, and supply was overwhelming demand. So the fundamentals heading into the summer of 1990 were bearish. The Iraq War of 1990-1991 caused a brief spike, but once the geopolitical headlines began to age, and it became apparent that regardless of what happened in this war, there was unlikely to be a large enough disruption of global oil supplies to really cause the price of the supply-demand balance to retighten, the market began to refocus on the supply-demand balance, not maps of the Middle East, news headlines, and oil prices dropped right back where they were. And this is an extreme case from 35 years ago, okay? More recently, we've seen situations such as late 2019 where from Yemen, Houthi rebels launched drone attack on major Saudi Arabian oil production and export facilities. They caused an actual outage of millions of barrels a day of Iraqi oil Saudi Arabian oil production and exports. And yet oil prices only saw a less than 1 day spike and then resumed their downtrend. Again, the path of oil prices is all about supply and demand, not geopolitics. Geopolitics can cause temporary spikes, but over time, depending upon how big the geopolitical event is, those always fade and oil returns to reflecting supply and demand conditions. Now, I've had people tell me in the past, well, yeah, but one day, right, it could actually have a real impact on supply and demand, and the price of oil would sustainably go up. And sure, anything's possible, but one of the things I like to say is if by the time that actually happens, if it ever happens, which would be terrible, the people who are buying geopolitical headlines will maybe make back about a third of what they've lost chasing geopolitical headlines on all these occasions over the last 35 years. Geopolitics are not the key to oil prices. If you want my advice on that, it's this. When you start seeing military analysts show up on the mainstream media, when you start hearing people talking about closing the Straits of Hormuz, any headlines like that, it is time to lighten your exposure to energy, lighten your exposure to oil if you're long. And potentially, if supply-demand conditions are weak enough, it's a good opportunity to short oil from a trading perspective. That's certainly a pattern I've taken advantage of in our trading services countless occasions over the years, including late 2019. So with that, what are the supply-demand conditions for oil? Where am I looking in? Where are the opportunities in energy right now? Now that those geopolitical headlines are fading, we've seen oil prices collapse this week back to the mid-60s a barrel on WTI from those geopolitically driven spike highs. Well, let me start with a long-term chart of oil here. And this chart goes back to 2020. And what you can see is I've drawn two horizontal blue lines there. One is right around $65 a barrel and the other one's in the low 60s. Now, I would consider those lines to be an important technical support or resistance zone for oil, and you can see that it's been an important level for a long time. The early 2020 highs in oil were right around $65 a barrel. We've seen since the summer of 2022, we've seen, or 2021 rather, we've seen generally speaking sell-offs in oil to that $60 to $65 region bounce. So we've seen oil, this region act as support on the long-term chart of oil. Now, we dipped under that range here in early 2025, but we have quickly recovered above that range, and we recovered above that range even before the start of talk about the Israeli-Iranian conflict. And it's certainly before we heard any talk of the U.S. potentially entering this conflict in any way, which of course did happen. So you can see that oil prices had already recovered above that range even before the start of this recent conflict. So even before the start of the geopolitical headlines. And that's where we are right now. We're sitting right on support in oil in that $60 to $65 a barrel region. Here's a chart, a close-up chart of the same thing. I've left the two lines where they were previously, and you can see that in April, amid the tariff panic, we dipped under that level for a period of time, but that sell-off was not sustained. And oil quickly recovered in early June, again before the start of these talk of an issue between Israel and Iran, before Israel launched strikes on Iran's nuclear facilities. We actually saw oil prices recover above the low end of that support zone. Then we saw that quick spike up to the high 70s. And again, this is West Texas Intermediate oil futures. And over the past couple of days, we've seen an entire give back of that geopolitical spike. This is nothing unusual. Again, this always happens. So anybody who's surprised by this or telling you you should be surprised by this, it hasn't studied the history of the oil market and events like the 1990-1991 Iraq War, where the Persian Gulf conflict, the first Gulf War, whatever you want to call it, we saw exactly the same pattern. When the military invasion actually started, the move in oil was already totally unwound. So what we're seeing is oil right now back here in the mid-60s. Now, in my view, the supply-demand conditions for oil are a lot more bullish than the majority of investors think. You know, the Bank of America publishes a monthly global fund manager survey where they interview a number of fund managers with over $500 billion under management all over the world. And one thing that they found was that money managers are heavily underweight energy stocks. So they're heavily underweight energy stocks and commodities more broadly. In fact, there are 2 standard deviations underweight energy relative to the 20-plus year history. So they're very bearish on energy and oil prices and energy stocks. And typically that's a good contrarian signal. When everybody is betting the same way, when the crowd all thinks bearish on energy, that's a good time to look at buying opportunities in the group. And I do think we're there. Oil prices are sitting right on support levels, again, after that brief spike. And I think the market will revert to looking at supply and demand conditions out there over the next several months. And I think, again, that looks a lot more bullish than these fund managers apparently think. And keep in mind that these fund managers, the survey was conducted before the start of Israeli airstrikes targeting Iranian nuclear facilities, so it predates all this stuff, all this mess. It had nothing to do with geopolitical reasons. They were underweight energy heading into this. So I think oil prices are on support. At the same time, there are some issues in the oil market. On the bullish side, we have actually oil inventories are very close to are near 5-year seasonal lows here in the U.S. and also outside the U.S. At the same time, we've had a lot of headlines out of OPEC. OPEC agreeing to increase production by a large amount on 3 consecutive months, much larger than expected. But I think what's interesting about these bearish headlines that have hit oil this year is that they haven't really had much of a sustained impact on oil prices. As you can see here, oil briefly dipped under that support zone at the height of the tariff panic in early April, but has since recovered above that level, again, even before these geopolitical events caused that spike. One thing I would say, though, is that producers also agreed with me that geopolitics wasn't likely to create a big spike in oil, sustained rally in oil prices. And in fact, they took advantage of that spike in oil to hedge production. We can actually see that from the commitment of traders data released by the CFTC every week. It's released every Friday, but with a lag. So the most recent data we have is from June 17th of 2025, right? Which is just after the airstrike started on Iranian nuclear facilities. So it's really at the beginning of the conflict. But we already saw the beginnings of that spike higher in oil, and producers were already hedging their production. And again, we can see this in the commitment of traders data, specifically from commercial traders in the futures market. And the CFTC tells us the net position of commercial traders in the oil futures market, the West Texas Intermediate oil futures contract traded on NYMEX. And commercial traders are hedgers. These are companies involved in the energy business in one way or another. The largest people that are commercial traders in the oil market are producers, energy producers, who are generally looking to sell oil futures or buy put options, betting to hedge their exposure to energy prices. So they're almost always or the whole history of this series, they have been net short oil because producers are always going to have some hedges in place, and those hedges involve shorting oil, right? But what we can see is that in early April, we saw a spike down in oil, and these hedgers reduced their net short position to the lowest level we've seen in 15 years when oil prices spike lower. So they didn't believe that the spike lower was sustainable. That was down to the mid 50s. However, on June 17th, 2025, we saw a big increase in the net short position from these same hedgers, and this was when prices spiked up to the high 70s. So what that tells me is that just as they didn't see oil prices in the mid 50s as being sustainable, they don't see oil prices up near 80, 75 to 80 as being sustainable right now. And so they took advantage of that spike to sell oil, hedge, lock in those attractive prices. We, of course, don't know the full extent of that. We'll know a little bit more this Friday after the market close when we get the data from 1 week later. And we can see if they increase their hedge position even more, again, into that spike in oil. So I don't see a humongous amount of upside for oil over the next few months, but I don't see a lot of downside risk either. I think oil prices are likely to hold support in that, let's call it $61 to $65 a barrel level for West Texas Intermediate. But I don't see a supply-demand balance in effect to push us up to $75 or $80 or $85 a barrel between now and really the final quarter of this year. I do think that the upside risks greatly outweigh the downside risks as we head into 2026, but it's going to take time for this to show up in the oil market. We're going to have to see what impact, if any, this increase in OPEC production has on oil this summer. I already am seeing signs of strengthening demand for oil, not just here in the US, but globally in refining margins and refining stocks, which is an area of interest for me right now in terms of an actual advice we're making in the services I run. But it's going to take some time. So how do we trade energy for the rest of this year and going into 2026? Well, first up, I call this the curse of the ETF, right? The exchange traded fund. And don't get me wrong, I love ETFs. I recommend ETFs across several of the products I run. One of the products I run, called Smart Bonds, actually only invests in exchange traded funds tracking fixed income, credit, and preferred stock markets. However, not all ETFs are good. Some ETFs really don't reflect the totality of an industry group very well, and one classic example of that is energy-related exchange-traded funds. The most popular one is the Spider Energy Index, or XLE, which trades under the symbol XLE, which tracks the energy companies in the S&P 500, which means it's heavily weighted towards Exxon, Chevron, and Conoco, which make up almost 50% of the ETF. In addition, the ETF has very, very, very little exposure to anything other than oil. So most of the companies that are represented in that ETF have stocks that are heavily leveraged to what's going on in the oil market. So there's not a lot of gas exposure. There's really no nuclear exposure of any amount in the XLE ETF. There's very little midstream energy exposure, companies that own pipelines, storage facilities, assets of that nature. So when investors, and particularly individual investors, look at the energy market, they often look at things like XLE and they say, XLE has just not been performing well here in recent years. This chart shows the XLE ETF as a blue line on the top, and that orange line is actually the XLE ETF relative strength to the S&P 500. And you can see energy stocks performed terribly in early 2020. We saw that big collapse in commodity prices. They were dramatically underperforming the S&P 500. But we saw a big rally off those lows on both an absolute and relative basis for energy. For a few years there, energy was actually the top performing sector in the S&P 500. Now, since the summer of 2022, roughly, energy prices have been treading water, and that's particularly been the case over the last 2 years. Since the summer of 2023, I've boxed there a pretty obvious trading range in XLE, which kind of reflects that trading range we've seen in oil over the same time frame on that chart I showed you just a minute ago. On a relative basis, which again is that orange line, energy stocks have been basically underperforming the S&P 500 over this time frame. Energy stocks measured by XLE have been trading sideways, but the S&P 500 has continued its rally. It's up trading near all-time highs as I record this video. And so therefore, on a relative basis, energy stocks have seemed to be underperforming, right? But the reality is that, again, XLE does not reflect the totality of the energy market. It really reflects a bunch of stocks leveraged to oil. So if you're looking to say that energy isn't performing well, it really depends upon what part of the market you're looking at. And here's an example on this next slide. This is just over the past year. I put the S&P 500 as an orange line. This is total returns including dividends. I put that XLE ETF as a green line, the S&P 500 Energy Index. And then I put my top recommended natural gas producer as a blue line. And what you can see is that over this time period of past year, this is a daily chart, XLE is actually down slightly. It's down on the order of about 2 or 3% over the past year. The S&P 500, it's up around 12%, 11-12% over the last year, including dividends. But this natural gas E&P stock that I recommend across several of their publications is actually up almost 50% as I'm recording this video over the past year. So there are areas in energy that have performed very well. Natural gas, nuclear has been another one that we've recommended a lot, midstream. It's just not the big ETFs that track the energy sector that are where you need to be. You need to be much more selective than that. Now, with that point in mind, here are a few areas I'm looking at right now. As I said, my commodity outlook is simply for oil, is simply that there's limited downside risk from here, but it's going to take some time for the supply-demand balance to tighten up enough for us to see significant upside. I suspect we'll probably trade here in this range in the mid-60s up to maybe the low to mid-70s. I do not think we're going to see a retest of the lows we saw earlier this year in the mid-50s, partly because if oil were to get down there, you would see U.S. oil production begin to fall very rapidly, which would serve as sort of a counter-cyclical driver, if you will. Shrinking global supply of oil because U.S. production is falling would help tighten up the oil market. The other event risk out there would be a global recession, but I just don't see that over the next 9 to 12 months or so. Mainly, and one of the reasons for that, as far as energy is concerned, is the refining stocks have really been leading energy lately. Refiners are generally sensitive to global oil demand, not the price of oil. So in fact, refiners are one area that I'm looking at very closely right now. We already have some exposure to it in our energy-focused publications, and I'm actually looking to add exposure to refining stocks to some of our more general publications as well. I think that's an interesting area. We're seeing these stocks break out technically, and we're seeing signs of very tight global market for products, gasoline and diesel fuel, and so refining margins are actually on the mend. I continue to like natural gas. The main driver of natural gas prices since late last year, I think a lot of people think it's been growing electricity demand. That is an ongoing tailwind, but I think the more important driver this year and early next year is that 4 billion cubic feet of new liquefied natural gas export capacity is going on stream here in the US. There's more coming on stream in Canada, and so that's pushing up natural gas prices all along the curve here in the US. A lot of producers that obviously couldn't make money consistently or generate free cash flow at $2 a million BTUs last year, they can generate copious amounts of free cash flow at $3.50 or $4.50, which are the price levels we're seeing for natural gas futures from this summer all the way out through the middle of next year. So I think there's still some gas in the tank there. As far as oil specifically, oil-related stocks specifically, I am looking at producers that have a very low cost of production. So these are companies that can generate free cash flow with oil even in the 40s or 50s. Because I don't expect oil to go that low, but I think that in the current market environment, mid-60s to say low to mid-70s, these companies can still generate copious amounts of free cash flow to pay dividends, buy back stock, take all kinds of shareholder-friendly moves. I'm also prefer companies that don't have a lot of debt. So I'm looking for energy producers with low cost of production, room to adjust their production higher or lower as oil prices improve, I think, at some point into early next year or in the middle of next year, say over the next year. They could actually increase production to take advantage of that. But also they don't have a lot of debt, which means that more of that free cash flow is going to be used for other things. In particular, either making accretive acquisitions of companies at very low prices, but I think even more importantly in many cases, dividends and buybacks. In particular, one of the E&Ps I'm looking at adding to some of the portfolios right now has a current dividend yield of well over 4%. And I think that's pretty attractive in the current market environment. Now, you may have to be a little bit patient with these oil companies. I don't see a lot of downside risk there, but it may take a few months for the market to really get going on the upside. When it does, I see an awful lot of upside for a lot of these energy stocks, partly because, as I said, asset managers around the world are so underweight the sector. When oil prices begin to improve sustainably, when these stocks as these stocks continue to work, because they're already, in many cases, higher actually year to date, if you're looking at the right energy companies. I expect to see a big shift of capital in favor of the sector, which could drive another wave of outperformance, kind of like what we saw through most of 2021, 2022, and into the first half of 2023. So that's kind of what I want to talk about on the video today. Ignore geopolitical headlines. They are not the key to the oil market. In fact, just the opposite. You should fade them. I do see, while most people only look at oil and ETFs like XLE, there are a ton of opportunities in specific subgroups and niches of the energy market. I gave you some examples: refining, natural gas, and low-cost U.S. shale oil producers with low debt. So those are some of the things I'm looking at. I'm going to be adding some of these stocks to the portfolios here in the next few weeks. If you'd like to take advantage of our current free trial offers, we have free trials on several of our services available right now. You can click the link below this video. So thanks again for listening. I hope you found this helpful. Any questions or comments, drop them below. Thanks again.